Goldman Sachs falling hard today, down 7% after the bank missed expectations on weak trading activity and higher costs. Jason Goldberg, Barclays senior equity analyst, joins us now to discuss. Jason, those two factors I just mentioned for why the shares declined don't sound that severe, yet the share price decline was severe. Why such a big pullback?
Yeah, I think part of it is, kind of buying the rumors, selling the news. You did have a strong run on the shares, throughout the course of last year, and financials in general got off to 2022 on a strong footing. You kind of had to thread the needle this quarter, and they didn't quite do that. So you saw the sharp reaction downward.
We could go through some of your calls and which are the ones with the highest price targets. But before we get to that, Morgan Stanley traded back 4 or 5% today. It's down 12.5% from its high in the first or second week of January. Should it have pulled back as much as it did today and this week in light of Goldman's numbers ahead of Morgan Stanley's own report tomorrow?
Yeah, I think similarly, right, the shares performed well there as well last year. But I think, unlike Goldman, they aren't as reliant on trading revenues, given the build out of both the asset management and wealth management businesses over the last several years. So not relying on trading. Expenses is still a question mark. Clearly, you saw it from JP Morgan last week and Goldman Sachs this week, that the banks are taking the opportunity to invest more to remain competitive. And we do look for some of those cost pressures to weigh on Morgan Stanley as well.
Did you guys and investors just not appreciate the extent to which inflation hits the banks as well, whether it's wage inflation or what David Solomon today, inflation in all aspects of the real economy and how that would ramp up their expenses, and they weren't just net beneficiaries, I guess, from higher interest rates? Was that the sort of surprise here?
I think revenues have come in good, revenues have come in, generally in line to ahead of expectations. I think what you've seen companies do and kind of reinvest part of those proceeds to kind of aid future revenue growth. So while, in 2021, you saw them banks kind of invest excess revenue driven by the fee income side, as they look ahead to 2022, it looks like better than expected interest rates benefits will now go to kind of fuel some of that investment spending to remain competitive both against other banks, non-banks, and fintech and big tech alike.